Now, to reinforce your learning, what I am going to do is, I am going to do one more case, again from the same prescribed textbook. The case is titled as Maynard Company A and Maynard Company B. Maynard Company A in chapter 2 and Maynard Company B in chapter 3. I am going to solve that case. What is that case on? Preparing a balance sheet and an income statement. We are going to prepare a balance sheet and income statement based on the Maynard Company Cafe case, and then let us see if we can, how we can take it forward from there, out there, because that will give you a better understanding of the balance sheet and the income statement. Now we continue as indicated with the Maynard Company case out there. Maynard Company A and Maynard Company B, as you can see on the screen. Similar to Lone Pine Cafe, Maynard Company B is to do with the income statement, Maynard Company A is to do with the balance sheet, and let us focus on the balance sheet preparation first, then let us go to the income statement out there. Let us focus on the balance sheet preparation first, and then let us go to the income statement preparation. I am just going to read this whole thing out here, and then let us try and see if we can make some sense out of it. Dan Maynard was made the following request to a friend. My bookkeeper has quit and I need to see the balance sheets of my company. He has left behind a book with the numbers already entered in it. Would you be willing to prepare a balance sheet to show me? Also, any comments that you make about the numbers would be appreciated. The cash account is healthy, which is a good sign, and he has told me that the net income in June was about 19,635. Net income was 19,635, that is mentioned out here. The book contained the detailed record of the transactions, and from it the friend was able to copy of the balances at the beginning of the month and end of the month as shown in exhibit 1. This is exhibit 1. This gives you 1st of June what is the balance, on 30th of June what is the balance. Dan Maynard owned all the stock of Maynard Company. At the end of June, Dan Maynard paid herself $11,700 as dividend and used the money to repay her loan from the company. That is fine, and this is what it is, all the balances. Now it says, let us answer only the first question. Let us not worry about all that. Prepare the balance sheets as of 1st and 30th of June. Two balance sheets, opening and closing balance sheet as on 30th of June. These are the details which are all given out here. The balances are all given out here. It is a very simple task. All I have to do is classify which is an asset, which is a liability, and go on preparing out. But before we get into it, I am going to talk about one more aspect of it. Normally, when we talk about asset or liability, we have two broad classifications. Normally, the classifications are long term or short term. Short term is also called as current, long term is also called as non-current. Any kind of an asset or a liability are classified under the short term and long term. It can be short term or it can be non-current. Liabilities can be again current or non-current. Now, what is the difference between the current and non-current? Any liability which is due in the short term, usually within a period of a year, are all classified as current liabilities. Any liability which is not due in the immediate future, within normally the next 1 year, they are all called as long term or non-current liabilities. Now, one can argue with me, sir, you said 1 year, I have to pay something in 365 days, 1 year. I have to pay something in 367 days. So, does it not become non-current? Because it is just 1 year and 2 days? Well, your organizations, you will have to make some bit of judgments there as to classifying what is payment immediate or what is a long term payment. So, that 1 year is not what is called as, it is not a Chinese wall out there, it is a got a sort of an indication to you what is the classification between long and short. Similarly, when we talk about assets also, we classify as short term and long term assets, or we don't say long term assets, we will say non current assets, current assets and non current assets. What do you mean by non current assets out there? Assets which do not change the form very frequently. For example, I buy a building. The building value will change because of depreciation at the end of every year, agreed, but the building as a building remains as a building, does not change the form every now and then out there. The building is 15,000 square feet, it remains as 15,000 square feet, so it does not change the form quite often out there, like you have cash in the cash box. I would have cash in the cash box. Every minute the cash can keep, the quantum of cash what I have can keep changing, because I might be paying some people, I might be receiving money from somebody, and then the quantum of cash can keep changing. Well, it is current, it is liquid, it changes the form every minute or changes the form very frequently. I buy an automobile, I use the automobile and then I sell the automobile after a few years, perfectly fine. You might sell value, say depreciation, all that is fine, but the automobile as such as remains as an automobile, it does not change the form. Simple. Receivables or debtors. As and when I keep selling goods, my debtors are increasing every day, every minute. And as and when I am receiving money from the customers to whom I have sold last month, last year, etc., my debtors is coming down at the same time, and one more. So, what is happening? Your debtors per se keeps changing the form continuously. So, these are all called as short term assets or current assets. Any asset which does not change the form, which remains as it is, patent. I own a patent, the patent remains as a patent. That is, it has a value, it of course depreciates and everything, that is fine, but it remains a patent. These are all called as non-current assets out there. So, normally when we present assets and liabilities, we will always present it with classifications. That is, it is a current liability, current asset, it is a long-term liability, non-current assets out there. So, these assets, liabilities regrouped into multiple forms is very essential, and that is how we are going to look at it when we prepare what is called as Maynard Company case out there. In Maynard Company case, what have I classified? I have classified assets as current assets, non-current assets, liabilities as what do you call it as current liabilities and non-current liabilities. That is extremely important when we do this. Why do we need it? We will learn as we go along, because for example, all my short term liabilities, current liabilities, how will I fund? It has to be met by my what is called as my current assets. Very simple. I receive money on the sale that I made last month. I have to pay on the purchases that I made last month. How will I pay? I will receive from that fellow, I will pay this fellow. So, what happens? My current liability is being met by my current asset out there. So, that is why one of the examples. So, all these groupings are essential. Now, let us look at this aspect of it. I am preparing the balance sheet side by side as of June 1st, as of June 30th. Balance sheet as of June 1st and as of June 30th. I am preparing the balance sheet both. Let us not look at the income statement. I will come back to income statement in a few minutes from now. Let me read one by one. Accounts payable, let me get the keyboard. Accounts payable for on 1st of June something, on 30th of June something. So, accounts first thing, accounts payable. What is accounts payable? That is, you have to pay for the purchases that you have made. So, is it current? Yes, it is current liability. Why? Because normally credit period about less than a year, 90 days, 60 days, 45 days. Number 2, this position of these payables will also keep changing every minute. As you go on buying, it will go on increasing. As you go on paying, it will go on reducing out. The form will basically change. So, it is what is called as a current liability. What is it? Accounts payable. Account. What is the amount out there? 8517 for 1st of June, and 21,315 as of 30th of June out there. I am sorry, next column. So, what is it? Why is it? Why is then some numbers appearing here and here? Nothing. I am just totaling the current assets. It will just appear as a total, as you can see on the formula bar out there. As I am just totaling it out there. That's all. Nothing else other than that. Next, accounts receivable. What is it? It's a current asset. Similar, exactly similar. Accounts receivable. Accounts receivable. That is, you have to receive for the sales that you have made. Always current. It will keep, the form will keep changing every minute. As you go on selling, it will go on increasing. As you go on receiving, it will go on reducing. So, this is a continuous cycle that keeps happening. So, accounts receivable. What is the amount of accounts receivable? 21,798 and then 26,505. Next, accrued wages payable. Wages you pay for an employee's staff. Accrued wages payable. Accrued wages means what? The wages have accrued. That fellow has performed the job for me. I have not paid. He has performed the job. I have enjoyed the benefits of his labor, but I have not paid. It is accrued. It is payable. Then what is it? It is a liability. What kind of liability? Normally, these are current liabilities. This will not be never be a long term liability. Accrued wages payable, that is 1974, and then what is the amount? 2202 out there, and this is what is the accrued wages payable. That it just gets totaled out there. That's all. Next, we say accumulated depreciation on building, accumulated depreciation on equipment, etc. Now, what is this accumulated depreciation? Let me go back and explain out here in this case. Let me go back and explain. I will let us take, for example, I will say year 1 beginning of the year 1. I prepare a balance sheet. I have a building worth about 10 lakhs. This is building at cost. Beginning of year 2, what will be the balance sheet? The balance sheet will look like building 10 lakhs at cost out there minus depreciation for the first year, between the first year 1st of January and the next year 1st of January. Let us say depreciation is 1 lakh, and then let us say 9 lakhs is the value of the building. Now, in this particular case out there, let me take year 3 beginning. Same thing, my building is worth about 10 lakhs. Depreciation carried forward from the last year is accumulated depreciation is 1 lakh. Current depreciation is what is called as 1 lakh out there. So, total depreciation is 2 lakhs, value of the building is 8 lakhs. Year 4 beginning again, my building is 10 lakhs. Depreciation accumulated in the first 2 years, year 2 and year 3, year 1 to year 2, year 2 to year 3, in the accumulated depreciation 2 lakhs. Current depreciation for the current year, 3rd to 4th year, 1 lakh. Total accumulated depreciation on the machine, 3 lakhs. So, 7 lakhs is the value of the machine. So, what is depreciation accumulated? The depreciation that has accumulated on the particular asset out there, the depreciation, the clubbing in this particular case, what is the total accumulated depreciation? Year 1 to year 2, 1 lakh. Year 2 to year 3, 1 lakh. Year 3 to year 4, 1 lakh. Total accumulated depreciation, 3 lakhs. So, what is it? The asset is always shown at cost. At cost means the original purchase value. The original purchase value, the asset is always shown at cost, what we call it as the original purchase value minus all the accumulated depreciation, that is depreciation on the asset charged from the day it is purchased till today is all accumulated depreciation. If once you reduce the accumulated depreciation value, the net value is what you call it as the value of the building out there. I purchased building at 10 lakhs at cost. After 5 years, what is the accumulated depreciation from the day I buy till the 5th year till today? The depreciation on that asset is 4 lakhs. So, 4 lakhs is gone, 6 lakhs is the value or what is called as the net block of the asset out there. So, what we call it in this particular case, I use something as at cost. Normally they will say gross block minus depreciation is what we call it as the net block. So, this is the language that normally is used when we work on numbers out there. Now, coming back here, I am just going to get my keyboard again. In this case, accumulated depreciation on building, accumulated depreciation on equipment. For that, I need to know what is the building value. There is building out there, banknotes we will leave it. Building, you see in both on 1st of June as well as on 30th of June, you see the value of the building is the same 5 lakh and 585,000. 585,000, that is building at cost, at the original value, at the initial value, at the purchase value out there. So, what is the value of the, and what is building? Building is a non-current asset out there. Non-current asset, it is going to be a long-term asset. The other name for it is a fixed asset. Yes, it is a fixed asset, building. That is, what is the price of the building? 585,000, and then price of the building is 585,000 out there. 585,000 in this particular case. So, that is what is building out there. Now, on this, I need to know what is the value of the building minus less accumulated depreciation. That is the amount of money that is depreciated right from the day I purchased the building till today, accumulated depreciation. Here it is 156,000, and then whereas at the end of the month it has become 157,950. That means what has happened? Between 1st of January, 1st of June and 30th of June, the building has depreciated further by $1,950 or 50 rupees. It was 156,000 at the 1st of June, depreciation. Now, depreciation has become 157,950 between 1st and 30th of June. The value of the building has reduced further by $1,950 out there or 950 rupees out there. That is what we call it as depreciation. Same thing we will do for machinery. What is called as machinery? Equipment, sorry, they say equipment. They do not say machinery, they say equipment. They have said equipment at cost. They have clearly given at cost. Because what has happened, initial 1st of June, the equipment cost is 13,260, whereas 30th of June, the equipment cost has become 36,660. That means what? The difference between the two is what you purchased, because that is all these at cost. At cost means at the original value. You initially had building worth about 13,000 rupees. Now you have building, you had equipment worth about 13,000 rupees. Now you have an equipment worth about 36,660. That means 36,660 minus, if I have to just calculate out here, that means you have basically purchased about 23,400 rupees worth of equipment between 1st and 30th of June. You have purchased about 23,400 rupees worth of equipment between 1st and 30th of June. That is where it has increased. It is at cost. On this there is accumulated depreciation. Less accumulated depreciation. What is the accumulated depreciation on the equipment? 5304, and then it is about 5928 out there in this case. So, what happens? The equipment, it is a non-current asset, as you can see in this particular case. So, this is the value, this is the value, this is the value of the building as of 30th of June, this is the value of the building as of 1st of June. How come it has increased? It has increased because you have made a purchase. That is where at cost, that cost itself you can see the value increasing out there. Next, I would say bank notes payable. Bank notes payable. Normally what is called as, it is all what we call it as the current liability. Bank notes, you have to pay to the bank, that is notes, you have to, the money that is due to the bank for some discounting or whatever it is. Bank notes payable. Obviously it will be a current asset. How do you classify? It will basically, these are all will be short term. If it is long term, it would be mentioned that it is long term out there. If it is long term, it will always be mentioned that it will be long term out there. These are all what we call it as the short term liability. Short term liability out there. After banknotes payable, we saw building, yes. Then next, capital stock. Capital stock means the capital, equity. Sir, why do they say capital stock? Is it not share? Yes. What is the price of the stock? What is the price of the share? Colloquially used, capital, that is all. Capital means it is sort of equity out there. Shareholders equity is what I have got out here, capital stock. What is the capital stock in this particular case? 390,000. Capital stock out here is 390,000. That is the amount of capital that is there. Then what we have? Cash. Cash is what? Obviously current asset out there. Obviously what is called as a current asset out there. I am just moving out here and then I will say cash. What is the cash that is there at the beginning? 34,983. What is the cash at the end of the period? That is about 66,660. 660 out there. Next, merchandise inventory. Inventory is what? Current asset. Inventory is raw material. Merchandise inventory, raw material which you own out there. So what happens? It is nothing but current. Why it is a current asset? Your raw material will not remain the same for a long time. It will keep changing every minute. Every minute you are utilizing, it is reducing. Every minute you are purchasing, it is increasing. So raw material will change the form quite frequently. So inventory. Even the same thing with finished goods, inventory. You will keep, as the production is on, you will keep accumulating. As your dealer picks up from your godown, the finished goods stock will keep coming down in the process. So merchandise inventory. Inventory is nothing but a current asset out there, that is 29,835 and then 26,520 out there. That is all. I am just entering the balances, doing nothing. Notes receivable from Maynard. Sir, it is Maynard's company. Yes, Maynard is different, Maynard's company is different. Please note, entity concept. Maynard is different, Maynard's company is different. Now, the lady Maynard owes 11,700 rupees to basically what do you call it as the company out there as of 1st of June. As of 30th of June, she does not owe anything, she has paid it off. So, when I say notes receivable from Maynard, if you look at, it is 11,700 out there and it is basically 0 out here in this particular case. Notes receivable, the company has to receive the money, so it is an asset. Maynard Company has to receive the money from Dan Maynard. So, it is an asset. It is an asset for you. That is it. Then we see other non-current assets out there. Other non-current assets out there. Let us see non-current assets in this particular case. I am going to say other non-current assets. What is the other non-current asset out here? The other non-current asset in this particular case is 4857 and then about 5265. Then other non-current liabilities out here, other non-current liabilities. I have given a slot here 2451 and then it remains at 2451. Then there is something called as prepaid insurance. You have paid in advance, you have not enjoyed the benefits of it, then what happens? It is obviously an asset. What kind of an asset? It is a current asset. Normally it will be used within a year or so. Sir, if it is 5-year prepaid insurance, will it not be a fixed asset? Will it not be a non-current asset? Well, yes and no. Yes and no. Normally current out there, you are not going to pay a 5-year premium. Nobody is going to collect a 5-year premium from you because it is very, very difficult to assess the risk and everything. So, it is basically what you call prepaid insurance. Prepaid insurance, if you look at in this particular case, the prepaid insurance out there is about 3150 and then in this particular case is about 2826. Next, retained earnings. Retained earnings is what? Belongs to whom? Belongs to the capital provider. So, what happens? I got to add it to the capital stock out there. Retained earnings. Retained earnings in this particular case 221, 511, 229, 446. So, what happens? Total shareholders equity, please note the total shareholders equity is always capital stock plus retained earnings. Capital stock plus retained earnings out there is total shareholders equity out there. That is what we have written. Last two items, supplies on hand. Supplies on hand, it is always a current asset for you. Supplies, that is supplies, some may be some lubricants, some things out there. Supplies, it is your own, something which you own. Supplies on hand, what is the amount of supplies on hand? 5559 and then 6630. Then you have taxes payable. Taxes payable, what is it? It is a current liability. Payable, it is a current liability. Taxes payable, it is nothing but a current liability of 5700 and 7224. So, are we complete? Or we entered the taxes payable as a liability 7224 we have entered. Are we complete? Have we missed anything? Yes, we have missed something. We have missed something called land out there. Land is what? Land is a long term non-current asset out there, land. What is the value of the land? If you, as per the books, 89,700 is the value of the land and it is 89,700 is the value of the land out there. So, now let us see whether the assets and liabilities are matching. Assets is about 638,538 as of 1st of June, 681,888 as of 30th of June. Let us see what is the value of the asset, liabilities and equity. Liabilities and equity 638,538 as of 1st of June and 681,888 as of basically the 30th of June. So, that finishes your assets and liabilities. That is, we have what you call it as all your assets and all your liabilities. Now, from there we need to move to what is called as the income statement out there, that is Maynard Company B. I would suggest you try solving Maynard Company B in the lines of Lone Pine Cafe. We will revisit it. Thank you.